So the Fed held Fed funds rate the same. They didn't do anything. The government may shut down. Are these obstacles or are they roadblocks for mortgage rates coming down? We're going to get into that and so much more in today's housing market update. As we get into this, let's look at the big three. Prices are steady. All right, they're not going down. We'll talk a little bit about that. Inventory again, typically goes down this time of the year, and that's no different. And then interest rates are roughly the same as we end the week. Let's look at the headline news. Home price appreciation still rising. We'll talk about the gold standard for home price appreciation across the country here in a minute. The Fed held steady on the Fed funds rate. What does that mean for mortgage rates moving forward? And then what is the impact of a government shutdown on mortgage rates? Are we going to have another one? God, 2 and 3 months? Come on now. The people in D.C., we need to replace them, but we'll talk about that later. What is the true cost of buying a home? We got these no down payment programs, but does that mean no money out of pocket? We'll get into that. And the VA rates, we'll take a quick look at the charts. We'll see that where they're moving kind of sideways right now. And the Case-Shiller Home Price Index came out. This is reporting the home price appreciation for the month of November. And for the fourth month in a row, we had positive month-over-month appreciation at 0.4% month-over-month. So that's great news. Again, fourth month in a row. We're at 1.4% year-over-year appreciation. Again, this is across the country. If you break that down to 20-city index, bigger cities, still at 1.4%. So really very solid considering we have been in a high rate environment for much of the last 2.5 years. What this positive rate appreciation shows is that lowering interest rates, which we have seen since July, mortgage rates coming down, has helped home price appreciation increase. Again, August, September, 0.2, October, November, 0.4%. We might even see the same or higher for the month of December when we get those readings next month. So the Fed met this week, the first time they met for 2026, and they left rates unchanged. This is the Fed funds rate, the short-term overnight rates between lenders and banks. They left it at 3.625. There were two people who dissented, Fed President Waller and Fed President Moran. They both wanted a 25 basis point cut, but the majority ruled and we kept it where we're at. One of the biggest reasons is because of the upgraded economic outlook. When you take a look at the GDP report that came out, it was hotter than what we expected. So that shows overall a strong economy. And unemployment, which has gone up, it actually went down last month to 4.4%. So, hey, you know what? Job gains, they've remained low. Unemployment really is showing signs of stabilization according to the Fed. Again, 4.6% down to 4.4% unemployment. And inflation is somewhat elevated at 2.7%. They're still kind of talking about tariffs having an impact, but really inflation is steady. They want to see it come down, so holding steady. And then obviously the Fed made their decision, but the thing that always really carries the weight of the day and impacts mortgage rates, I'd say even more than what they decide, is what Fed Chair Powell says afterwards. And afterwards, he's starting to see disinflation continuing in the service sector. He still, again, is talking about tariff impact on goods inflation, and he thinks labor will do better because of stronger economic activity. Now, I don't know about that. We just had Amazon announce 16,000 layoffs. UPS, I think 32,000 people being laid off. That's not just because they don't need these people. They're just not downsizing. These companies are laying off because of efficiencies that they are starting to build using AI into their work processes. So here's another interesting thing. 15 of the 19 members of the Fed believe that the Fed funds rate is above neutral, which means they really should be bringing the Fed funds rate down. But and then the other question Fed Chair Powell got asked was, hey, are you going to stay on? He ain't going to stay on, folks. There's no way that guy's staying on. He just go retire, go do your thing, and President Trump may stop pummeling you on a daily basis. And yes, President Trump was hammering Fed Chair Powell again today because they did not lower the Fed funds rate. So what is the impact of the Fed staying put? Well, short term, which is really the next couple days to next few months, there'll be no relief rally. We're not going to see a big rally on interest rates. All right, when the Fed doesn't cut, it kind of removes hope. And mortgage rates tend to stay elevated or drift higher because the bond market is already priced in this disappointment. All right, no cut basically equals no catalyst for the rates to move. And the volatility will stay high. Rates can still move daily, but they're going to be in a pretty tight range, and that's what we've seen over the last couple weeks. And every inflation print, every jobs report, and every Fed speaking becomes a landmine for mortgage pricing. So that's really what's going to move in the short term, interest rates up or down. Nothing that the Fed did today. The long-term impact, 6 to 24 months, mortgage rates ultimately are going to follow inflation. They're not going to follow the Fed. All right. If holding rates continues to bring inflation down, then long-term treasury yields will fall and mortgage rates will come down even without the Fed making the cuts. And this is the part that most consumers missed. And delayed cuts can also mean deep cuts faster. By staying restrictive longer, the Fed risks an economic slowdown. And if growth cracks, bond yields drop fast and mortgage rates often fall before the Fed officially cuts. So what's the bottom line? Hey, the Fed controls overnight money, but mortgage rates are controlled by inflation, growth expectations, and the bond market. The Fed not cutting doesn't mean mortgage rates can't fall. It just means the path is bumpier. All right, so now we've got another situation where the government may shut down because our Senate, again, is failing us. What did Warren Buffett say? As a litmus test, one way to get a balanced budget, one way to get rid of debt is if Congress cannot pass a budget that is within 3% or 3% of GDP, then they do not get another term. They get one term and done. Wouldn't that be great? But I digress. How will a government shutdown impact rates today? Well, shutdowns typically, they don't push rates sharply higher. If anything, they can nudge them modestly lower as investors seek safety. And then when they seek safety, they invest in treasuries. And that investment in treasuries pushes mortgage rates down. The duration, though, matters. Short lapses equal minimal impact. Prolonged standoffs is a clearer downward twitch in long-term yields. And one of the other things that we saw this at the end of the year when we had the last government shutdown, the lack of official data, it increases the volatility in the market because you're not getting all the reports that you normally get. And so that masks the impact or the rate impact until after the shutdown resolves. So really, we're left guessing. And again, the markets don't like guessing. And when they guess, rates go higher. And then the post-shutdown reopening and Fed action usually will reset expectations, which can reverse any shutdown-related rate drift. So basically, it's the yin-yang of them shutting down. Rates will go down a little bit when they shut and then come up a little bit. And if you look at the charts, you can see, this chart here, this shows the last couple shutdowns that we had. You see that in the end of 2025, you saw interest rates went down, but they also went up. They went down and up. They're a little volatile, but they went down during that shutdown. 2018, 2019 shutdown, you can see they also went down, but they steadied out for a little bit, and then they kind of continued on their path. And that was also because at the end of 2018, the Fed started lowering the Fed funds rate. Oh yeah, don't you forget that. I didn't forget that. And then also you see 2013, the shutdown, what happened? You saw interest rates, they kind of steadied out, but then they started to go back down. So we'll see what happens, but really, government shutdown, it's not good for anybody. It's really not good for our country. And quite frankly, it's despicable that our country leadership cannot come to a budget, cannot come to an agreement, cannot talk to each other civilly, so that we can live our lives. Because guarantee, if we don't pay our bills, we get kicked out of our houses, right, folks? Am I right? I am right. All right, let's go unfuck ourselves, Congress. Thank you very much. That's all I have to say about that. Think the price on the listing is what buying a home really cost? Spoiler alert, it's not. Buying a home is exciting, but a lot of buyers get blindsided by costs no one warned them about. Today, I'm pulling back the curtain so there are no surprises. Buyers often miss inspections and appraisals. Home inspections, pest inspections, sewer scopes, each one adds up. Appraisals are required by lenders and paid upfront, typically. Closing costs? Lender fees, title, insurance, escrow fees, recording fees, typically 2 to 5% of the purchase price, depending on the market. Then you got prepaid expenses. You got property taxes, homeowners insurance, and prepaid interest. These aren't fees, but they do hit your wallet at closing. Movers, trucks, deposits for utilities, internet, and HOA fees. The house might be new, your expenses definitely are not. That small fix adds up fast once you own the place. The goal isn't to scare you, it's to help you plan smarter. Buyers who understand these costs up front feel confident, not stressed when it's time to close. If you're thinking about buying, let's map out the real numbers together. Like, subscribe, and reach out if you want a personalized breakdown. Okay, we are at the end of January. 2026 is in full effect. We only got 11/12 of the way through 2026. And some of you had some financial goals going into 2026, maybe to make them better so that you could buy a home or buy a new car or just be responsible, be grown up. Well, actually, most grown-ups don't handle their money well, so just be responsible. So here's some personal finance tips for you as we get into 2026. It's not too late. Even if your New Year's resolution is already past an opening, let's start again, all right? Hey, what's a habit? All right, it's okay if you miss one day. Just don't let yourself miss 2 days, because then that is another habit you're creating, all right? So here, let's talk about personal finance tips. Build an emergency fund. 2 to 3 months of expenses or of your income is what you really want to have. Ideally 6 months, and then 12 months of what your expenses are you want to have as that emergency fund. Pay down high interest debt. 29% credit cards. I wouldn't count on 10%, what President Trump is trying to make these credit card issuers do. You get your high interest debt paid down. Be very disciplined. Do the snowball effect. Follow the Dave Ramsey. Do whatever it takes, but pay that high interest debt down. Contribute to your own 401k. And if you are not contributing to your own 401k and you're getting matched by your employer, you're a knucklehead. All right, because you're just passing up free money. Why would you do that? Exactly. 401k, invest. All right, and then invest in your future. Grow your wealth through real estate and or the stock market. Fully, most Americans, especially people who are falling behind, guess what they're not doing? They're not investing in the stock market. We see these great companies like NVIDIA grow and make a ton of money, or Palantir. But you know what? The regular Jane and Joe doesn't invest. They will never reap the benefits of those investments because they never invest. They're living paycheck to paycheck. You got to be disciplined. Maybe it's $100 a month. Maybe it's $50 a month. The key is you got to get it done. Invest in your future. And then build and maintain good credit. Your financial report card in life is your credit score. You don't want to go through life being an F student in finances. Get your credit score up. The higher your credit score, the better your grades, the better opportunities you're going to have, not only to use somebody else's money, which is always nice, but to really achieve what you want financially in life. So, hey, let 2026 be the year where you positively change your life, and you do it by being disciplined, by being responsible, by being frugal, all right? You don't need to go to Starbucks every day. Save some money, get your credit score up, and then, you know what? You rely on nobody, all right? You don't have to worry about the government shutting down because you're safe, all right? And you're not only safe, but you're succeeding in life financially. All right, it opens up a lot of doors, that's all I'm saying. All right, capiche. And let's talk about VA rates. VA rates down slightly this week. We started the week at 5.88. As of the end of business on Thursday, we're at 5.83. So really right in the 5.8% range. Again, nothing really moving the needle. Just a lot of stuff going on domestically. not really impacting rates so much. The government shutdown will impact rates a little bit if we have one. But next week is a big week. It is jobs week. We're going to get our jobs report, ADP, private sector jobs report, and then at the end of the week, the Bureau of Labor and Statistics jobs report. Will unemployment go up? Again, a lot of layoffs being announced by some of the big tech and bigger S&P 500 companies. Will that impact us this month? Probably not, but going forward, it probably will. You guys have a great week, and don't forget to like, comment, subscribe, and let me know what you think. Do you think rates will go down if the government shuts down? And actually, right below, what is your number one financial goal in 2026? I'd like to know. Maybe I can help you out. All right, have a great week.